Hey, what's going on, traders? Hope you guys are doing well today. In this video, I wanted to talk about how to hedge or protect a portfolio using futures. So we're going to talk a little bit about hedging in this video, and I want to explain to you some very basic examples of how you can use futures to hedge and why futures are among the most beneficial instruments to do hedging with. So let's get to it, guys. If you enjoyed the content, smash the like button, and that's how we do it around here. Here we go. The first thing is, in regards to futures contracts, it's all about capital efficiency. A futures contract only requires an investor to put up a portion of the notional value of that contract in order to control the entire contract. So they're providing the investor with leverage or exposure to an asset class without necessarily paying for all of it. That's part of the advantage with futures, and that's one of the big reasons as to why investors tend to gravitate towards futures when it comes to hedging or balancing their portfolios. That being said, a lot of the existing futures contracts have quite high notional values, but what's interesting is that there's actually a lot of new contracts coming out that have smaller notional values that allow investors with smaller accounts to control their exposure a little bit better. So I'm going to try and cover a few of those things in this video here, and I will also give you a couple of detailed examples to explain it. So when it comes to hedging, there's no such thing as a perfect hedge unless you're trading the same market with a different product. Example, if you're long on Nasdaq ETF shares, QQQ, if you shorted the Nasdaq futures, that would be a way of evening out your long exposure risk to the underlying position you have here. When you hedge, you're either removing exposure to a market or you're balancing the overall exposure that your portfolio has to an asset class. So here's the first example that I'm going to give. So you have a portfolio and you're long 40% on tech stocks and you're long 40% on small caps. The remaining 20% is just cash in your account. Over time, you've maintained this balance in your account, and all of a sudden you've noticed that your tech stock position is performing very well. You've made multiple hundreds of percent on this side, and on this side maybe you've only made a few percent profit. Logically, at some point, our investor is going to have to rebalance this portfolio because of the large increase in value of this side of their position. It is now overweighing the value of their small cap position. So they have multiple choices as to how they're going to balance this out. Now, the first choice they can do is to sell off some of their long position, which again may not be ideal because let's say this is a long-term position that they plan to hold forever. They don't want to sell off the stock position. What they'll do is they'll try to find a way to even out this position or reduce the risk in this position. And this is where we get to hedging. So this investor's long position on the Qs, the value of this position is $100,000. They are long $100,000 worth of tech stocks. So one option our investor has here is he can go into the futures market and he can sell NQ or any futures contract that falls under the same correlation. This is where we have to get into understanding what is the value we are selling in these futures contracts. The way you calculate the notional value of a futures contract is very simple. You first need to find the multiplier of your contract. In the case of NQ, it's 20 times the Nasdaq 100 index. You take the value of the contract. So we're just going to say the Nasdaq's at 14,000 and we're going to multiply that by 20. So Nasdaq is valued at 14,000. The contract has a multiplier of 20. So the notional value of one NQ contract is $280,000. The value of our underlying position is only $100,000. So this futures contract is clearly too big for our account. Because if we sold one NQ, we would be selling $280,000 worth of Nasdaq. We're already long $100,000 worth in our portfolio. So if we sold one, we would actually reverse our position to being short 180. So this is too big for us. As many of you know, there is a micro contract that trades on the CME. It's 10 times smaller than this contract right here. So this 20 here becomes a 2. Let's calculate the notional value of the micro Nasdaq contract, MNQ. So again, the contract's valued at 14,000 times 2, and that gives us a notional value of 28,000. So you can see now that this is more reasonable and workable for our underlying position of $100,000 long in the Qs. So now for every contract we go into the futures market and sell of the micro Nasdaq contract, we would be reducing our long exposure by 28,000 a contract. So if you sold 2 of them, you would reduce your $100,000 exposure by 56,000, basically cutting your exposure in half. Now, some of you might be asking, I don't really know many people who have this amount of exposure to the technology sector, because the average individual trader, maybe they're trading a $10,000 or a $20,000 account. Their exposure to tech stocks is only $10,000. The micro Nasdaq contract with a notional value of 28,000 is almost triple the size of your underlying long position. The question is now, is there any contract that is smaller than the micro Nasdaq? The answer is yes. There is one on the small exchange. It's this one right here, STIX Small Technology 60. So I'm on the small exchange website here, and if you scroll down, you'll see that the notional size of this contract is 6,600. So our investor with $10,000 exposure here, if they went into the futures market and they initiated a short position in one of these contracts, they would be reducing their long exposure by 6,600. Now that is theoretically, of course. The issue with this is that this small technology 60 is an index of its own. It is not the Nasdaq 100 index. This brings us to the next point here, which is we need to look at what the correlation is to the actual technology sector. First thing I'm going to do here is I'm going to find a platform that has this symbol. Interactive Brokers has this symbol under STX SME, and what I'm going to do now is chart this out on the TWS platform, and I'm going to get an index comparison to see how it correlates to the Nasdaq 100 stock index, which I'm long $10,000 worth of. Here we go. So now there's a line being plotted that is supposed to represent the Nasdaq 100 against this technology 60 index by the small exchange. Now if you look closely, you can see that it's pretty closely correlated here. I'll zoom out a bit and look at the daily chart, and you can see on a daily chart it looks as if it's about a 90% correlation here. So it's pretty close, but I would definitely encourage you to do that research on your own as well to see how closely correlated this actually is to your position. If you use this instrument as a hedging device, and for whatever reason it's no longer correlated to your underlying position, then that's going to pose a big problem for you because you're not going to be hedging it anymore. So this contract right here is an option that investors have when it comes to hedging against a technology sector position with a smaller exposure, you know, $10,000, $20,000 exposure. Control your risk with this contract a little better. And of course, we didn't even talk about the capital requirement for this, and you can see here that the exchange margins are about $550 here, which is really low. So you basically have to put up only a fraction of the value of this position in order to sell short 6,600 worth of tech stocks, which is going to hedge against your initial long position worth 10,000. That was the example we gave in the video here. All right, guys, so this video was just to explain some basic concepts relating to hedging and how you can use futures contracts to either reduce or balance the overall exposure in your portfolios. So if you enjoyed the video, leave a like, and I'll catch you in the next one. Take care. Bye.